Gautam Duggad, Head of Research at Motilal Oswal. And again, one of those big voices and an opportune time to bring him because we've just closed the Q4 numbers now and we've had also some amount of time to digest the print both on the large cap as well as mid and small cap front. So, sir, let me set up this conversation by starting off with that. How was the Q4 print in your opinion? And what pockets really stood out for you in terms of the Q4 numbers?
Hi, good afternoon. Thanks for having me here. So fourth quarter was the best quarter of FY25. Let me begin by saying that. The first three quarters were flat. This quarter also we were expecting flattish performance. So against our expectation of 2% earnings growth, we got 10. So numbers were better than expectations. More importantly, the spread of earnings was far better. 75% of our coverage universe has delivered numbers which is either in line or ahead of expectations. This number usually is 60-65%. So the spread is far better. Third, the number of sectors which have beaten expectations are quite high. 19 sectors have delivered numbers which are either in line or ahead of expectations. And only 3 sectors have disappointed. Nifty also earnings growth of about 3%, but that's largely owing to IndusInd Bank. Otherwise, against expectation of 3%, the growth would have been 5-6%. The last point on earnings is if you look at it in terms of the SEBI-defined criteria of market cap categorization, then large caps have done quite okay, 10% growth. The real stunner came from mid caps. For the 89 mid cap companies that we cover, the earnings growth stood at 19%, which is far better than expectations. We were expecting 10% growth. And the only sore point throughout the result season was a weakish performance of small caps. So we were expecting decline any which ways. We were expecting a decline of 12% on small caps. The actual decline stood at 16% and largely led by financials. But even if you exclude financials, the small cap earnings stood flattish. Right now, this is broadly the aggregate sectors which have done well: metals, pharmaceuticals, consumer durables, EMS, even auto and cement and capital goods. They defied expectations and delivered numbers better than what we were estimating. Right. So amongst big sectors, almost every sector has met expectations or has beaten expectations. Forward earnings are still a little bit, I would say, tricky because we've again cut the numbers by close to 2% for FY26 and about 1% for FY27. So we are looking at about 12% earnings growth this year in FY26 and close to 14-15% in FY27.
Okay. Sir, do you believe that some of the numbers or some of the growth that you are penciling in for FY26 will be front-ended? And does that warrant, and if that were to play out, would that warrant a material upside to the current levels that we're seeing on the large cap as well as the broader market index?
No, I don't think so. I mean, see, numbers are going to be fairly well distributed because the first 3 quarters also has a low base effect of last year, FY25. But we are not expecting any big dispersion in earnings growth in 4 quarters. As regards the upside, I think, look, Nifty has traveled from 22,500 in March to somewhere close to 24,800 now. So there has almost been a 10 to 12% rally in the last 3 months. From here, the rally will be a function of 2 things, right? One, obviously the underlying corporate earnings, and second, the global environment. Because do remember that we fell in Jan and Feb not only because of problems pertaining to India, but there was this trade war which was unfolding every single day. Then in between we got geopolitics and then India-Pak border tensions. Some of those issues have receded into the background. Earnings are improving. Having said that, Nifty is now trading at 21.5 times 1 year forward versus a long period average of 20. So the room for valuation expansion is quite limited right now. And also in mid and small cap, it is going to be very difficult to build a big upside given that they are still trading at a substantial premium versus their own long period average as well as versus Nifty, right? So mid cap index is trading almost close to 29-30 times, right? Versus Nifty valuation of somewhere close to 21.5 times. So basically, to address your question, from here, the upside is going to be very, I know it sounds cliche, but stock specific and bottoms up, right? At 22,500 Nifty, when we spoke last, the valuations were looking quite attractive because Nifty was trading below 20 times that time, which is below long period average. But now it is at 21.5 times. Plus, you're talking about still 10-12% earnings growth, not 15-20%. So I would be surprised if there is a material upside. While we are constructive, we are more constructive on a bottoms-up basis, sector by sector, rather than on a top-down index basis.
Gautam, good afternoon. Neeraj here. When I looked at your note, you spoke about how metals and OMCs propelled earnings growth, and the OMC numbers, for example, were far ahead of your estimates. I was talking to somebody in the morning who believed that now OMCs have accounted for the LPG losses in FY25 and FY26 earnings will be strong. So I'm just trying to understand. Oil prices subdued, Q4 exit rate good. If your assessment of FY26 numbers are also strong, is that OMC pack a bucket that is placed favorably from an earnings and an investability perspective?
See, Neeraj, it's very difficult to predict OMC earnings even in
That's
best of
true.
times. Right? So I won't hazard a guess there as to how those earnings will pan out, because for all we know, a quarter or two down the line, things might change. As regards investability, they have always been value plays because they always trade at mid-single digit P multiples or 1.5 time price to book. But they are essentially trading stocks, right? And they remain a trading stock. Whether they deliver good earnings or bad earnings, that doesn't change the investment thesis of OMCs. So yeah, I mean, if valuations are okay and you have a very benign view on the crude prices and their refining margins, marketing margins are doing quite okay, then yes, we can build a case of a trading upside. But you cannot take a very long-term view on OMCs, neither on earnings nor on stock performance.
So what drives this 14% PAT growth for you in that universe, Motilal Oswal universe? I mean, because you have mentioned oil and gas as one of that. So what? Is it something else? And what else contributes to this earnings growth? And where is it? Sorry, two questions rolled into one, Gautam. Where is it that within this earnings growth expectations that you have, where the valuations are also a lot more reasonable and predictable?
So look, the earnings are fairly well distributed, because when you predict the earnings for a year plus one, they always look well distributed. So if I look at FY26, I remember auto is very flattish. That's what we are penciling in. And after a long time, private banks will have a sub 10% growth. In fact, FY25 was also 8%, but this will now be the second year in a row where private banks will have a single digit earnings growth. So is the case with PSU banks. I'm talking about Nifty. So sectors where we are expecting decent growth is NBFCs, capital goods, cement, which is going to rebound after two very bad years. Pharmaceutical will continue to have a low double digit kind of a growth. And then, of course, the big kicker is coming from commodities, metals, where we are expecting almost 30% growth on a low base, right? And oil and gas, where last year earnings declined 14%, and now we are expecting for FY26 the earnings to grow 12%. So between metals and oil and gas, they account for a decent portion of incremental delta. Rest for consumer, we are expecting low double digit growth, IT somewhere about 7-8%. And that's how the blend of all of that put together, you get close to 12% growth.
Got it. Okay. Gautam, where is it that you're skeptical?
So I'm skeptical more on the underlying, you're asking about earnings, right?
Earnings growth.
Yeah. Yeah. So I would think that some of these numbers, especially, and I'll give you both upside and upside and downside surprises that can happen. So on the downside, I think maybe cement, capital goods, some of these infra capex oriented companies might have some disappointment ahead, given that the government has changed its stance more towards consumption over capex. Even though the March numbers will make you believe that government is going all out on capex, because government has spent 2.5 lakh crore, almost 2.4 trillion in the month of March alone for capex, and that's how they have met their full year FY25 capex target of 10.2 trillion. I mean, Neeraj, 2.4 trillion was the capex done by India in entire FY15 put together. And now we are doing it on a monthly basis. I mean, maybe March is an exception. So that is a space where I think numbers might, shake a little bit. I think consumer, auto, financials, IT, those numbers will be met, even pharma for that matter. And then, of course, metals and oil and gas is in nobody's case. You cannot predict those earnings. You have to just mark to market every quarter and see how the underlying commodity prices are behaving. So broadly, that is where we stand on balance as to where we think numbers are going to be in the realm of achievement, and some segments where we think there might be some possibility of a modest cut going forward. But I will still think that on a top-down basis, when you juggle with all this intersectoral mix, top-down, you might still get 10 to 12% Nifty earnings growth next year.
Point taken. Gautam, Last question with regard to your view on the defense and the PSU pack as a whole. Defense in particular, because of the rally we've seen, that changes things substantially, or do you believe that there is merit in the kind of rally that we've seen? And then PSUs as well, just touch upon your view there.
Sure. So on defense, we're very clear. We like some of the names like Hindustan Aeronautics, Bharat Electronics, but the problem is we initiated coverage in March on HAL with an upside of 27%. That upside was achieved in 1 month. So near-term upside may be limited, right? Same is the case with Zen Technology, which we cover. It's up from 900 to whatever 2100 in a matter of 3-4 months. So what has happened is July 2024, the peak market cap of defense companies in India, that had reached close to, I think, 9 or 10 trillion, right? From the, or maybe 12 or 13 trillion that point of time. From there, we had come off 30-35% by March. And now we are again approaching the same sort of a number within a matter of 2 months. So if you look at the combined market cap of defense companies which are listed in India, between March to now, the market cap is of 65%. So while the underlying story will remain very attractive from a next 3 to 5 year basis, given the focus on defense preparedness, indigenization, new technology and all of that, but the stock price behavior may be slightly different, given that a lot of the potential growth is now getting reflected in the current stock price.
A very, very engaging conversation, as always, is with you, and any kind of timeline is short when it comes to speaking to you. So thank you so much for taking out time and speaking with us.
Thank you.